Thank you. It's my, thank you. More glasses. Shh. Thank you. If you don't know or recognize our next two guests, you should at least pretend to. Or you may have registered for the wrong conference. Either way, we're glad you're with us. Rodgin Cohen is Senior Chairman of Sullivan and Cromwell, LLP, having served as chairman from 2000 to 2009. The primary focus of Mr. Cohen's practice is regulatory, enforcement, acquisition, and securities law matters for U.S. and non-U.S. banking and other financial institutions, and their trade associations and corporate governance matters for a wide variety of organizations. Mr. Cohen advises the financial services industry on the full range of regulatory, merger and acquisition, governance, compliance, and enforcement matters, including multi-agency investigations relating to compliance with anti-money laundering and sanctions issues. He has been donned the trauma surgeon of Wall Street and the viceroy of all Western capitalism. That's a compliment. I was not a dig at any. Jelena McWilliams arrived in the U.S. on her 18th birthday with $500 in her pocket.
That's what you start with?
That's how you started your...
He's like chairman emeritus and...
Jelena and I are good friends. We're good friends. Since arriving in the U.S. on her 18th birthday with $500 in her pocket, Ms. McWilliams graduated with highest honors from UC Berkeley and earned her law degree from UC Berkeley School of Law. She practiced corporate and securities law at Morrison & Foerster in Palo Alto, California, and Hogan & Hartson in D.C. From 2007 to 2010, Ms. McWilliams served as an attorney at the Federal Reserve Board of Governors in the Division of Consumer and Community Affairs. From there, Ms. McWilliams worked in the United States Senate for 6 years as chief counsel and deputy staff director with the Senate Committee on Banking, Housing, and Urban Affairs. I had the privilege of working with her for 2 of those years, where I learned that it's Jelena, not Jelena or Jelena or any other variety.
But you can call me Raj.
She's very good on her feet. Ms. McWilliams was Executive Vice President, Chief Legal Officer, and Corporate Secretary for Fifth Third Bank in Cincinnati, Ohio. At Fifth Third Bank, she served as a member of the executive management team and on numerous committees. In June 2018, she was sworn in as the 21st Chairman of the Fdic, where she's serving a 6-year term on the Board of Directors and is designated as Chairman for a term of 5 years. Jelena has brought joy and dedication and hard work to each of these roles. Please join me in welcoming Chair McWilliams and Rodgin Cohen.
Thank you very much, Mike. I'd like just to add to his introduction of the chairman with one statistic. I think Jelena has the highest first impression quotient of anybody I have ever met. And by that I mean the first time somebody goes to meet her and comes back and reports, it's always the same response. Wow, is she impressive? And frankly, when you get to the second impression, it's just as good.
It takes 3. And it goes down.
Well, that's why you don't have the third meeting, right?
No.
So I thought we might begin with the late-breaking news. There were 2 announcements of significance, at least yesterday, by the FDIC. The first one was a proposed rulemaking to deal with what is known as the Madden decision. At the risk of editorializing, the proposal would return the law to the way it was written and interpreted by the Supreme Court. And the second matter yesterday was the FDIC's approval of the bank aspect of the SunTrust BB&T merger. So probably everybody's read the releases. I'd be interested in what color and observations you would have as well.
I have no color and observations on those 2. all joking aside, so on Madden and the interest rate portability, it's important that we uphold the sanctity of the contract, and that has been the precedent by the Supreme Court cases for 100 years. And the fact that we had one court decide otherwise created dichotomy and disparity in our financial regulatory framework. And frankly, we need to ensure that banks are able to function. Secondary market is important, and being able to sell loans is an important function for banks to basically manage their risk as well. And so it was important for us to opine and seek comments on how to proceed going forward. So we issued a notice of proposed rulemaking on that. We have had the guidance in place for 20 plus years. And so we're looking to both codify our guidance as appropriate and also provide an opportunity to the public to comment and allow us to shape policy based on the data that's available to you and sometimes not available to us. And on the merger, I think I see the two CEOs. Your staff did good jobs, and you did fulfilling the statutory requirements. And as I like to say, you made it very difficult to decline you. So, yeah.
So, one other editorial comment: if you don't think regulatory leadership makes a difference, think about the NPR yesterday on Madden and the comparable one or I guess Tuesday by the FDIC and yesterday by the comptroller. Did I get them reversed? In any event, if you go back and look at the regulatory sort of quasi-silence at the time Madden was working its way through the courts, it really does make a difference. Let me turn next to the Community Reinvestment Act. I suspect there would be something close to unanimity among both the community groups and the banks that this is a statute and regulation which really needs modernization because the whole banking industry has changed. Could you discuss whether you see CRA reform as a high priority for yourself and for the other agencies to the extent you've discussed it with them, and any prognosis as to what could happen?
So what did the comptroller say this morning? Here's where we are. The agencies have been engaged in the prudential banking agencies, the Fed, OCC, and the FDIC, have been engaged in multi-agency effort, joint agency effort on coming out with a proposal for how to reshape our regulatory framework with respect to the Community Reinvestment Act. And we generally agree on several things. One is that with banks shifting more to the digital delivery channels and having some banks that only have digital delivery channels, how do we look at the assessment area? And branches are still important. There are still people like us that go to branches, those millennials don't, but branches are still important. And so right now, the way we look at the deposit taking activity, it's all based on the branch location. But if you look at the digital delivery channels, it's not so much about the branch location, it's about where the consumer is located and wherever you send your notices and what address you have on file. So we need to reassess both what an assessment area looks like and also to provide more certainty to institutions that are looking to invest in their communities, how to do it. And the formula shouldn't change, meaning it shouldn't matter what kind of a rating you are or what kind of rating you have or where you are in the CRA cycle, whether you're in the first 3-year cycle or the second 3-year cycle of a 7-year investment. That investment should qualify, and there should be certainty to you as a bank so that you know when you're looking at your spreadsheets that when you go into the CRA exam, you know whether or not you have met the requirements or exceeded them. Banks generally want to be outstanding. Some are satisfactory, but generally, banks are doing a very good job complying with the CRA requirements. Where we can do better is certainty and addressing some of the changes in the delivery channels that we have. I am still optimistic that we can get an interagency NPR. Now, I'm inclined to, if the Fed doesn't go with us, I'm inclined to join the FDIC. the OCC, because I do think there is a benefit in having something out there for you to comment on. And I'm going to give a shout out to Michael Hoon, but it's important for us to get feedback from the folks who are in this space, from bankers as well, and just understand how should we reshape the framework moving forward. It hasn't been touched really since 1995. It became law in 1977, and then we did some revisions. The agencies did in 1995. So many things have changed since then. And I do think you deserve an opportunity to you as public to comment on provide your feedback on how to change the framework, because in the end you're the practitioners on the ground, whether you're on the community side or you're on the banking side, and you know the best how these investments have been done in the lending, et cetera, and how difficult it has been for you to figure out, are communities getting enough? Are you doing enough? And so if we can provide that certainty for you, I'm willing to go, somewhat on a limb and propose, frankly, something that may not be perfect, but it's going to at least open up the conversation and give you an opportunity to comment.
So I'll turn to an issue where you don't have to worry about interagency cooperation, it's your own, and that's brokered deposits. And you have moved for the first time in maybe since the beginning of that era to address this issue. But once again, I think the question relates to the changes in the way banking products and services are delivered and the types of products and services. And there is, as I assume everybody knows, the proposal out there. Could you talk a bit about what you see as your objectives with this proposed regulation and where you see it going?
Yeah. So broker deposit, in my view, the rulemaking we have in place, the rules we have in place, they have been around for at least 20 years. We did some tweaks here and there, but nothing significant enough. And frankly, they fall, for my intents and purposes as the chairman of the FDIC, they fall in the category of rules that we absolutely have to revisit. Now, I don't know what the end outcome of that is going to be, but rules are too complicated. The delivery channels and how banks are collecting deposits and aggregating deposits has changed in those 20 years dramatically. And frankly, we need to address the changes in the marketplace because we're just way behind. And there's also uncertainty because we have relied on a general counsel's opinion. We generally don't issue general counsel's opinion. So it's a little bit of a hodgepodge of things, how we have been looking at broker deposits. We do have different segments of what broker deposits generally end up being. We look at sweeps and the prepaid cards, et cetera. But we're going to be coming out with a proposal pretty soon, I'm hoping by the end of the year, on, again, giving you an opportunity to provide your feedback and tell us how you're looking at deposits and whether the notion of a broker deposit being hot money, as we traditionally have been approaching them is still valid, and if not, how the framework that we have should be changed.
Thank you. So let me turn to a different issue, which is perhaps at the forefront, I think, for the banking industry. And that is the relationship with technology and more specifically with the so-called fintech companies, which is a very broad term. What do we have? What should we have? Do we have partners, competitors, something in between? And I would suggest this issue is becoming even more of an imperative to be addressed by the industry and the regulators, because now we see fintech moving beyond loans. I mean, banks have always competed with non-banks for loans, but they've never had to compete all that much for deposit and payment services, and that's where the fintech movement seems to be going. So how do you see this as evolving? What is the FDIC's role? What are your personal views on where it should go?
Yeah. So I tell generally people my personal views play no role in our policy making. And here's why. We have congressional statutes that are guiding our work, and we have to do what Congress tells us to do. We have some regulatory discretion in that work, but we have to be judicious about the exercise of the regulatory discretion. So when we look at technology and the developments that have happened in the banking industry beyond banks, I think that fintechs are both competitors and partners in this space. I think they started out as competitors, and they have banks have, especially small banks, have kind of wisened up and became partners with the fintechs, realizing that the delivery channels and the agility of the technology companies to provide some of the banking services when teaming up with a bank is more than the bank can do on their own. And so there's a plus-plus relationship there that frankly can be very symbiotic. But I think we need to take a step back and ask, why has so much of financial services offerings and products and just general delivery channels developed outside of the banks? In the end, banks have been on the forefront of innovation for so long. And what happened, I think, partly due to the crisis, financial crisis, and partly due to the regulatory risk aversion in general, we have, I think, created an environment where a lot of banks are concerned about innovating. And so you'll innovate a little bit, but you won't go all far out because it takes a lot of money. And so if you go to a regulatory agency and you say, hey, we just spent $500,000, and that's a good case, that's a small amount, or $1 million, thinking about this prototype or this product we're going to offer, can you give us some feedback as to whether or not you're going to be comfortable with us offering this? We're not going to tell you yes or no. It's just not how regulatory agencies are, right? And so you're going to be reluctant to now plunge in $10 million in the development of that product when you know that 6 months later we can come after you for a UDAP violation in your disclosures that you just didn't think about at the time. And so it's important for us to create an environment where banks are encouraged to innovate. And whether that means that they partner up with the fintechs and they offer innovative solutions, digital platforms and technology based on what the fintechs are providing, or the banks develop that within their ecosystem, either way, I'm okay with that. But I do think there is an opportunity for us on the regulatory side to do a little bit more. So we're looking to do a couple of things. I went to San Francisco and Silicon Valley, and I met with about 24, 25 fintechs, and they all partner up with banks. And I said, what are you hearing from the banks when you go to partner up with them about us, about the regulators, and where are you seeing some of the obstacles in your ability to partner up with banks? And by the way, how did you even think about your business model? What was it that banks weren't doing that prompted you to think about offering this? And so we know that the use of alternative data has been something that banks have been not as eager, again, for sound underwriting purposes, to adopt as much as the technology companies have been. So we're coming out with a joint interagency guidance on the use of alternative data and how to look for consumer protection issues if you are using alternative data. We're also going to come out with an interagency guidance on the, artificial intelligence and machine learning. And we'll try to give you as much as we can, at least if not the rules of the road, then the framework as to how we're looking at all of this. And then we can think beyond that, what does innovation mean and what else regulators have to do. We're also creating the Office of Innovation at the FDIC, and the purpose of this office is really to look into these issues and figure out how can banks partner up with fintechs and where are the regulatory obstacles, because in the end, it's fine if some of this is developing on technology and customer products, consumer products are developing outside of the banks. What you don't want to do is create a regulatory arbitrage and obstacles to banks to do that. You want to create a level playing field. And if the banks are, if you have more regulation on banks that are in this space than you have on technology companies, you don't have a level playing field. And so we need to remove the obstacles to and barriers to innovation at banks and figure out, if we give you the roadmap or at least the framework, can you take that and run, and can you effectively compete? Because in the end, society and consumers benefit from competition.
So let me deal with what is maybe an offshoot, and that was the Facebook announcement of Libra. And that has really created a lot of focus, maybe for the first time, at least widely, on what is a cryptocurrency from a legal or regulatory perspective. Is it a security? Is it a deposit? Is it something else, something novel? But beyond the legal issue, which, as everyone heard, Jelena is more than qualified to discuss, what about the appropriate regulatory oversight? And what about the implications for the country as a whole?
Without endorsing or denying what's happening in that space, I think we need to be open-minded while careful. And walking that fine line, I think, from a regulatory perspective is important. Obviously, some kind of a crypto asset is developing in many different jurisdictions, right? And in addition to stablecoins and cryptocurrency, there are now discussions by central banks. What's the role for central banks in this space? The FDIC is not a central bank, but I do think that there's a broader policy discussion that we need to engage in, and we're frankly engaging in it in Washington with different regulatory agencies. We need to, as a country, make a decision. Do we see more benefit than downside to getting involved in this space? And if we see more benefit than downside, then the regulatory policy framework needs to be such that we decide: is it a commodity? Is it a security? Is it an asset? Or is it a deposit? right? And once we come to that, we kind of go down that waterfall, we will know who needs to regulate it and how, and whether or not at that point in time there's a place for the FDIC. I do think that we should be at least thinking through the issues that are facing folks who are involved in this space. And I don't think it should be an automatic no.
Just to continue for a moment, in the interagency discussions, is there, are the intelligence agencies part of that discussion?
I think they're always a part of the discussion, even when you don't know they're a part of the discussion.
Right, sorry.
Yeah, sorry, guys. Yes. So we're talking to the intelligence and law enforcement agencies on a number of different issues on an interagency basis. We're also talking to them about BSA and AML compliance and the regimes we have currently in place, because I think that's another area that's ripe for revisiting. Simply, we have technological advances now that we didn't have in the past in that space that we can do more. So we have engaged with law enforcement and intelligence and a number of different agencies to understand exactly how do they process information, analyze information, and gather information once banks file SARs. So we're talking to them in that space as well as in just space of cryptocurrency. The truth of the matter is you want to regulate things appropriately. And I think a healthy regulatory framework and a healthy regulatory system is like a seesaw. You balance out the need for protections while allowing enough room for innovation and progress to take place. And that seesaw is very kind of a carefully balanced. And I think with respect to crypto assets, you want to make sure that you know what the seesaw looks like, what the potential for abuse is. Right now, what you're seeing with a lot of the cryptocurrencies and assets is that they're quite often used in transactions that you necessarily wouldn't consider legitimate for the purposes of just general banking services. And that's something that we need to be cognizant of and work with law enforcement to understand exactly, if we were to endorse a cryptocurrency framework, regulatory framework, how are we going to tackle those issues?
Let me turn to an issue which you touched on earlier, which is the necessity for a review of what is this incredible web of bank regulations. And inevitably, you mentioned it in terms of CRA, it hadn't really been touched for decades. The CRA hasn't been touched, broker deposits hasn't been touched. Where do you see this whole process? Because it could just consume you, so there's got to be some focus. So where do you see this all coming out? And I'll ask specifically because it is top of mind for a number of banks, and that is the Reg O issue with principal shareholder and related persons.
See how he very skillfully asked me about the regulation that belongs to another agency. So let me try to force the Fed's hand. No, I'm kidding. When I joined the FDIC, I can only speak of my regulations. When I joined the FDIC, I basically gave staff a list. And I said, I want you to figure out, number one, which rules have not been updated at all in 10 plus years. And then take a look, 10, 20, believe it or not, 30 years. We have had regulations in place that have not been meaningfully updated. And I said, give me the list and then tell me which of these regulations have the most impact. So I'm looking for the most impact. Doesn't matter if it was 12 years ago that we revised it or 20 years ago, but if the regulation is extremely impactful on the marketplace and the regulated entities, we should tackle that one first. So we're going through that list for us. And I do think the regulatory agencies, frankly, have a duty to update regulations. You're an outside counsel to a number of folks in the room. The bottom line is I used to work at a law firm as well. You try as an outside counsel, as an inside counsel at your entities, you try to give advice to the management and the executive team on how to do something. And you have an executive team that generally wants to do the right thing. You have the general counsel who wants the executive team to do the right thing. And yet the regulations are not always up to date. Actually, they're seldom up to date. And that's a problem. So I do think that we need to be very cognizant of the need, if we're going to maintain the dominance of the United States financial system, we need to be agile on the regulatory side. We need to be agile in our delivery, and frankly, the willingness to revisit the regulations that have been in place for a long time. And at some point, you just have to have a backbone to say, hey, listen, some people are going to hate it, some people are going to like it, nobody's probably going to love it. But you know what? It's the right thing to do, and we're going to go out and just open it up for comment. And I think that's the only thing that's fair to do in our regulatory system. And now that I have this opportunity, I'm willing to take that risk.
So Jelena, without putting you on the spot, and I won't on Reg O, but that illustrates the point because it's the Fed's regulation, but both the controller and you have the responsibility for the banks for which you're the primary regulator. So as you try and, without focusing on that one in particular, how do you see this going forward since so many of these do have the interagency aspect to them?
So generally, the way this works, and I can write you a novel about this, it's going to be like a John Grisham detective story. Generally, the way it works, if the agencies, if all three banking regulatory agencies have jurisdiction over a regulation, usually the agency that has the primary jurisdiction would drive the process, and we would do an interagency rulemaking. Now, if it's something that, like the CRA, Congress just gave the CRA authorities to all three agencies, it doesn't matter who actually holds the pen. But usually the person that holds the pen, the agency that holds the pen, is the agency to which that regulation belongs. We have multiple venues through which we can actually work together to change regulations. You should be pleased to hear that there is a high level of cooperation right now among the agencies. And I was at the Fed 12 years ago, and I don't think it was as high as it is now. So Joseph Otting, Randy Quarles, and I have weekly calls. We talk every week. We have a list of things we're trying to get done. We talk about our priorities at each of the agencies and how we plan on moving forward. We kind of go down that list and figure out what needs to be done. For the purposes of the interagency rulemakings, the process just takes forever. So without disclosing too much, we have a list of things we would like to accomplish on an interagency basis, but it just takes an extraordinary amount of time. I think if you were to come from private industry to the agencies and try to move forward the joint rulemaking, it would just be, I think you would be abysmally disappointed at how long it takes.
Well, I was holding my breath when you said you were writing a novel because what immediately flashed into my mind was Animal Farm, not nutrition.
So long as you didn't say 1984.
Well, I was thinking that too, but I didn't want to say that one.
I'll take the pigs and humans over 1984, yes.
Right. Those humans, at least. Another issue which has been very much in the headlines, at long last perhaps, is the demise of Libor. And that's not a regulation, but it is an issue for the banking industry as a whole. Are there views that you have formed on this? Do you have an idea where you think the industry should be going?
Yeah. So a couple of things there. We still have banks that are originating mortgages and loans based on Libor. And it's a little bit of a pickle, right? Because you don't have a rate that has been officially endorsed. You have several competing rates that you can rely on, but Libor is still the predominant rate. And as we're looking to phase out Libor, and there are deadlines for that as well, and the ARC committee is looking to come up with a SOFR and whether SOFR makes sense. I don't want to endorse a single rate. We're not going. The FDIC is not going to endorse a single rate. But I do think we need to be cognizant of the market aspect of Libor versus non-market aspects of SOFR, and what does that mean for the marketplace? Because you want the agility in that rate, so that the rate can move with the market as the market move. And so I'm open-minded about what that rate should look like. But again, I think it's primarily, I think the Fed took the lead on. See, it's so easy when you can blame the Fed. I told Vice Chairman Quarles, I'm like, I don't care when we testify, so long as you and Otting are there. Yeah, thank you for that laughter. Yes, thank you. The truth of the matter is that we do need to be both open-minded and, frankly, a little bit more agile in how we're going to structure this rate and how quickly we can deliver something to the marketplace, because we still have banks originating loans based on Libor.
Right. So, not that Jelena ever needs to be taken off the hook, but when she said it's so easy to blame the Fed, she was talking about regulation, not monetary policy.
Oh, yeah, no. I don't. Yeah. I know which waters not to wade into. Yeah.
We talked at the very beginning, because of the BB&T SunTrust announcement yesterday, about consolidation, or at least touched on it. But interestingly enough, not only on that transaction, but on the First Horizon Iberia transaction, both sets of mergers really emphasize the importance of scale. And that makes, I think, everyone wonder, well, if you need to be X hundred billion or X tens of billions to achieve scale, and I'm not going to ask because nobody knows the answer as to what is the optimal size. But if scale is so important, what does that say about the future of the 5,000 plus banks who by any definition don't have, quote, scale, unquote, and what can be done to help them because they're the backbone of so much of American banking?
No, absolutely. So the economies of scale is probably one of the biggest advantages a company can have. If you have the market share and the ability to execute, and if you can price your offerings and services based on the broader area of those services and offerings rather than a smaller area, you of course have a per product or per service or per name it, per item advantage. And the economies of scale basically don't work to the advantage of the smaller banks. But this is, I think, there are three things we can do. One is that we can take a look at technology, right? So up until now, it was really difficult to reach, up until a few years, it was really difficult to reach customers. And you either had to take them from another bank, which is very expensive. So I get your flyers for, open up a new account with us, $300, $250. Or you can basically acquire a bank and acquire their portfolio and the customer base with you. I think now we're in a space where with some of the digital platforms, you can actually reach customers that you didn't think were potential customers for you. And so we do need to encourage technology and the adoption of technology and the development of technology at banks and allow banks to think creatively about reaching customers, whether it is through a small dollar offering or through products and services that are going to bring some of the unbanked or underbanked or people who have fallen out of the banking fold, but once were members of the had banking accounts. So I think technology is huge there. I think that we need to take a look at, frankly, regulatory burdens. If the regulatory burdens are holding back some of the entities from being able to offer products and services and evolve and grow, then we need to take a look at that and then ask the next question, is that regulation absolutely necessary? And if it is necessary, keep it, but find a way for it to work so that there's not unnecessary impediment or obstacle in place. And if it's not necessary, then why don't we take a look at it and figure out how can we deal with that issue in a different manner? And then I think the third thing to look at is just generally what do we anticipate that the banking sector is going to look like 10 years from now, 20 years from now, right? And are people going to be our customers? Are your customers going to be going to your digital platforms and never going to a branch? What's the role of cash anymore in this society, right? And how do we underwrite mortgages and what are we offering to customers? And I think as we look at all of that, we need to be cognizant that there's a role for small banks to play in this landscape. And so what we are doing, at least for the purpose of the small banks, is taking a look at every regulation that affects them and seeing if there is a way to take them out of the Basel framework. Small banks should not be part of the Basel framework. It was meant for large internationally connected banks, not small banks. And then taking a look at how can we remove some of the barriers to growth that they have. But consolidation is happening. It's to some extent inevitable. And as banks of all sizes face pressures from non-banks, credit unions, technology companies, and from the overseas as well, I just think we need to be as regulators cognizant of kind of the wins that they're facing on their journey.
Thank you. I would encourage other questioners. Hopefully this iPad is working because I only have two. But let me start with the first of those because we really would like to hear from you. And the first really follows right on with your answer. While encouraging community banks to partner with fintechs, arguably necessary for their survival, are there any dangers of large, well-funded fintechs taking advantage of the charter to the detriment of bank safety and soundness?
Absolutely. Of course, yes. And it's something that we're cognizant of. And frankly, So I think this person is asking two questions, one directly and one indirectly. And the direct question is, are we concerned about the tech companies getting into this space and partnering up with a bank to offer products and services that are traditionally banking products and services, but now the tech company is the one actually doing it, right? And it's something that we're frankly looking at and making sure we understand what the connection is. This is what I tell to the tech companies that come to the FDIC, and this brings me to the second component of this question, which I think is about the ILCs. The industrial loan corporations. This is what I tell the tech companies coming in and asking, hey, should we partner up with a bank? Should we get a banking charter, or should we become an ILC? Like, what's your recommendation? We usually don't give them recommendations. It's based on whatever their business model is. But here's the bottom line. If a tech company wants to be regulated like a bank, they're welcome to come on over. And so when people tell me, are you concerned, about, I won't name companies because I've learned not to do that, but if you're concerned about, this very, very large company that mines data all the time, having, a banking presence, I'm like, sure, they want to be regulated like a bank, come on over. We certainly, I have 6,000 people, we can hire 6,000 more, and we can regulate the heck out of you. So I do think it's important that we are cognizant. You want innovation to happen, but you don't want to create loopholes and create frankly, cracks in the system that entities that shouldn't be taking advantage of are taking advantage of.
So again, the only other, there are two questions, and then a reminder that you have to be out by 1:30, and you will. The next question was, could you comment on your views regarding innovation in regulation, just beyond, this goes beyond mine, which is just what is old and needs to be changed, but what should be new, and what progress in innovation do you expect in 2020?
So I don't necessarily look just like at 2020. I look at, my mandate is 5 years, as Mike mentioned, and so I'm here until 2023. And I think about beyond that. So what are banks of the future going to look like? How, is that ATM where you go to get cash? First of all, is it going to be an ATM? But then is it going to dispense, soy latte with your $200 in cash? And what is that cash going to look like? Is it going to be little coins without naming coins? And so the question is, what is this future of banking going to look like? And what do we need to do on the regulatory side to be, again, agile enough? We can't, the biggest problem we have on the regulatory side is that we make regulations based on the past events. So we look at the financial crisis and we say, well, X caused the financial crisis and we're going to address X. But the next crisis, there are some lessons that repeat themselves, but most often they actually don't necessarily repeat themselves verbatim, right? So you need to kind of figure out what it is that you're looking for forward. Where do you see the risk and how do you want to manage that risk? You want to allow banks to be able to evolve. Banks have been around for a long time. They have a point of service to the communities that they serve. They provide many benefits. They're businesses. They're for-profit businesses, and so you have to create this equilibrium where you take all of that into account, but you allow them to innovate. But frankly, that also means that regulators have to innovate and change. And so we're currently, we have created a supervision modernization subcommittee to our community bank advisory committee at the FDIC. And the purpose of that committee is basically to tell us how should we restructure our supervisory and regulatory regime. What is an examiner of the future going to look like? And by the way, I think it's going to be a data scientist. It's not going to be your good old 5 feet of loan document review person that sits in your office. It's going to be somebody who understands your algorithms, and we need to create that so that when we send you examiners that come to your bank and you're thinking about advancing your platforms and your offerings, that our examiners can communicate appropriately with your staff. And so we're also looking in terms of innovation, how can consumer protection evolve in that space, right? So now you have algorithms, and folks are telling me that algorithms have a potential that, depending on the input, of putting out stuff that could be potentially in violation of consumer protection laws. And so thinking through all of those issues, I just think we need to be really open-minded, and on the regulatory side, we need to admit we just don't have all the answers. And we don't. And we can't regulate everything as if it were done in the past century. And so having some flexibility doesn't mean it's deregulatory, it doesn't mean that we are undermining the safety and soundness or consumer protection, but being open-minded to the developments that are happening and just making sure that we're not in the way of innovation. Because in the end, why do we do what we do? You satisfy the safety and soundness on the regulatory side, you satisfy the consumer protection in regulations. But in the end, you do what you do because you offer banking products and services to your communities, right? We do what we do because we want to be able to say you're offering them in a manner that's safe and sound with adequate consumer protection. But in the end, it's the customer that matters the most. And you're not going to have that customer if that customer is not getting the digital offerings that they're getting from non-banks. You're not going to have that customer if you don't treat them well. And we're going to have a more difficult task if you end up in that position. And so there's a mutually beneficial environment here where I think we need to be a little bit more flexible in allowing you to innovate in how you move forward and not just being the agency, the regulator of no, but more so a regulator of how.
So I'm really not hiding behind the iPad to ask the difficult question, but it does come on anyway. So this question is...
Probably Sam Woodall probably sent you that. Yeah. Thanks, Sam.
Sam, that's right. We did discuss this one.
It's either Sam or Mitch. Where's Mitch? Mitch is the other one. I'm not sure if he's sending any quirky questions over here.
Okay. So the question is the 2% target right for the diff?
Oh, that's a Greg Baer question. I know exactly who sent that one. It's Greg or John. Here's the bottom line. Based on the failed bank data, so this is the 2% reserve ratio for the deposit insurance fund, and so we're all asking you to pay, and we're working towards 2%. We're currently at 1.41%. If there are any small banks here, you should have gotten the credits for the surcharge we imposed. And if you're not nodding, you're probably a big bank. And so as we're looking at the 2%, right? That number was based. I asked exactly that question when I walked into the FDIC, and it wasn't that I said it because I didn't think it was right or not. I just wanted to learn what went into the 2%. How did we come up with 2, and why not 2.5 or 1.5? And so they walked me, our staff, our economists walked me through the data analysis. We looked at the failed bank data, and we looked at where the deposit insurance fund has been historically since it was funded. Where has it been in comparison to the deposit base, and how did we weather each crisis? 2009, 2008 and 9, no, 2009 and 10, the diff was broke. I talk to foreign regulators all the time, and they think we have this absolutely superb system, and America is a wealthy country. I'm like, yeah, we were broke in the diff in 2009. So as we look at that, that's how they came up. Once they analyzed the data, they came up with 2%. And take that, Greg Baer, where are you? Yes, all right. Thank you.
So I'm just going to end this by going back to what I said at the beginning about first impressions, and now second and third and fifth. We really appreciate, Jelena, your candor, your transparency, and your innovation. It's fantastic having you there.
Well, thank you. So you can't invite me again, because that would be the third impression. All right, thank you all very much. Thank you.
Ladies and gentlemen, the next session in this room will begin at 2 p.m. It is the CEO Roundtable on Business of Banking. Once again, that session will begin at 2 p.m. As a reminder to download the conference app and submit your questions through that app. Thank you very much. We'll see you at 2 p.m.